Most people think the stock market is complicated on purpose. Charts everywhere, numbers flying, people yelling on TV, and the conclusion most people reach is simple: this isn't for me. But the truth is, the stock market is not complex. It's just poorly explained. So let's strip away the noise and talk about what's actually happening. The biggest misunderstanding is that most people believe the stock market is a place where prices magically move up and down, like some kind of casino. It's not. The stock market is just a system for owning pieces of real businesses. That's it. Nothing mystical, nothing abstract, just ownership. So what is a stock, really? When you buy a stock, you're not buying a ticker symbol. You're buying a small piece of a company, a real company, one that sells products, pays employees, and generates profit. And as an owner, you benefit when the business grows. The stock market is simply the place where those ownership pieces are traded. Now, why do prices move at all? Here's the simplest explanation. Prices move because people are constantly reevaluating what a business is worth. Not today, not this second, but over the future. If investors believe a company will earn more money in the future, they're willing to pay more today. If they believe future profits are at risk, they pay less. The price is a reflection of expectations. And underneath all of it, it's just supply and demand. Nothing more. At any moment, the stock price is simply an agreement between two people. One wants to sell, one wants to buy. If more people want to buy than sell, prices rise. If more people want to sell than buy, prices fall. There is no secret force behind it, just supply and demand. This also explains why news seems to move markets. You'll often hear, the market dropped because of the news. But that's not exactly true. The news doesn't move the market. The reaction to expectations does. News changes how people imagine the future, and the stock market is always pricing tomorrow, not today. That's also why volatility exists. If markets were perfectly predictable, prices would never move. But humans are emotional. Fear spreads faster than logic. Optimism spreads faster than patience. That's why prices swing, not because businesses change overnight, but because sentiment does. And here's another major point most people miss. The market is not the economy. The economy is what's happening today. The market is what investors think will happen tomorrow. That's why markets can rise during bad news and fall during good news. They're forward-looking. This is where long-term versus short-term thinking becomes everything. Short-term trading focuses on noise, headlines, emotions, predictions. Long-term investing focuses on fundamentals, revenue, profit, growth, time. The stock market rewards patience far more than intelligence, but timing feels so tempting. People want to buy at the bottom and sell at the top. It sounds logical. In reality, it's almost impossible, because the bottom feels terrifying and the top feels safe. Human psychology works against perfect timing, and that leads to an uncomfortable reality. Doing nothing often wins. Most long-term investors lose money not because they bought bad assets, but because they interfered too much. They panic, they react, they sell when fear is highest. The market rewards those who stay invested through uncertainty. Now, let's talk about indexes, because people hear that word and get confused. An index is not a stock, it's a measurement. A snapshot of how a group of businesses is performing together. When an index rises, it means the businesses inside it are growing overall. It's diversification in motion. And over time, markets tend to trend up, despite crashes, despite wars, despite recessions. Why? Because businesses adapt. People innovate. Productivity increases. The market is a reflection of human progress. That's why crashes are part of the system, not failures. Market crashes are not the end. They are resets. They happen when fear temporarily overwhelms logic. Every major crash in history felt like, this time is different, and every time the market eventually recovered. So what's the real risk? Most people think the real risk is volatility, the ups and downs, but the real risk isn't volatility. The real risk is not participating. Sitting in cash while the economy grows around you. Avoiding ownership while value compounds elsewhere. Volatility feels scary. Missing decades of growth is far scarier. And it helps to be clear about what the stock market is not. It is not a get-rich-quick scheme. It is not a casino. It is not a prediction contest. It is a long-term ownership system. It is a wealth-building tool. It is a patience machine. That's why simple beats complex. You don't need advanced strategies, insider information, or constant monitoring. You need time, consistency, and emotional control. Complexity often hides in security. Here's the core truth. The stock market doesn't reward people who are right often. It rewards people who stay invested the longest. Time in the market beats timing the market. Always. And here's a final thought. Once you understand how the stock market actually works, fear disappears. It stops feeling random. It stops feeling rigged. It becomes what it really is. A system that quietly rewards patience, ownership, and time. And the sooner you understand that, the earlier the system starts working for you.